Hello, Carter. Welcome to the 100X show.
Hi, thanks for having me on. Appreciate it.
So, Carter, I don't know if you know this. At Token Metrics and the whole community, we are very optimistic about Shade. We're very bullish on Shade. So just to tell the world that we really like the project, I wanted to delve deeper into different intricacies of the project. So I'll start off with this question. So I want everybody to know a little bit about your background and also the background of your team. So one particular individual that stood out for me was Guy Garcia. Like I've seen him be very active on your GitHub. Just tell me about yourself and some of your team members. So this question is basically your ability to ship product fast, solve problems, and also if there's a good founder market fit.
Totally. So I'll start with a brief background on myself. Been in the space since early 2017, late 2017. Started deep diving the space. Got introduced from a cousin of mine who's in TradFi. Started just doing an insane amount of research on DeFi and stable coins, and ended up realizing that a lot of the literature out there was either way too tech focused or way too investment focused. So my intro to the space was actually 3 years of writing a book. So I'm actually a published author, a book called Building Confidence in Blockchain. Feel free to check it out. And it was within that 3 years of research that it became super apparent that blockchain without privacy presents some very difficult problems on the adoption end of things, specifically for merchants and for payments. And a lot of these DeFi applications, when you have no privacy, you have these front-running problems that exist that are extremely expensive to solve when you're a totally transparent blockchain. So I started looking around for where is the tech stack that is prioritizing privacy for smart contracts. And that is where I found Secret Network in 2019 and 2020. Originally, it was called Enigma. It was a layer 2 privacy solution on Ethereum, but due to Ethereum's throughput problems, it ended up splitting off and ended up using the Cosmos SDK to build its own standalone blockchain. I've been super involved in that community. I'm actually the primary author of the Secret Network Gray Paper, as we call it. I ended up meeting Mohammed Petla, a node runner at the time, and we formed a software development company called Secure Secrets. And currently we secure over $30 million worth of assets across 5 different networks in the Cosmos. So we have a DevOps background. We're not strangers to the infrastructure side of things. And that partnership's been phenomenal. We immediately started to pivot to the software development side. We like node running, but what we're really fascinated about is there's this tech stack here, and it seems like privacy preserving DeFi is kind of untouched. It's unexplored. And Secret Network has these things called secret contracts, and they've only been live since 2020. It's the only blockchain with privacy preserving smart contracts where the software engineers can come in. You can choose what is publicly visible and what is not. Just super, super powerful smart contracts. So we started to gather a team. Mohammed is actually the person who met Guy Garcia. He was doing a hackathon to build a bridge from Polygon to Secret Network. Super talented. So we ended up just hopping on a call with him and said, like, hey, we have a vision for building out a suite of DeFi applications. Like, what's your vision? What's your dream? Like, how could you possibly fit into this? And we ended up totally clicking. Guy joined the team. I actually ended up bringing on my brother, Austin Woetzel, process engineer background, who's shifting towards the front end UI UX. Just an extremely methodical individual. It's an absolute honor to be able to work with a sibling. It's actually super, super special. And then I ended up also pulling in Jack Swenson, another contract developer, Kyle Wahlberg, another contract developer. And these are people that I was connected to in the university days. Pretty much approached them and was like, all right, like, I know you're doing something, but what we're doing is way more exciting. I promise you. And like, name your number. I know you're skilled. Like, let's make it happen. So those are a lot of the contract developers. Jack Sisson as well, another front-end dev. Carlos, another front-end dev. So collectively, the core team of developers is about 6 to 8 of us. I have a BS in computer science. I also have a BA in business with an emphasis in finance. So I can read pull requests. I can also talk with business people. But primarily I serve as the kind of lead product individual and economist with how all these products integrate. And as someone who spent 3 years doing deep research, I just live and breathe this stuff. This is what I love to do. This is the stuff I wake up at 4 a.m. and think about. and the whole team has just like this energy and like also admittedly like youthfulness to it. There's definitely it's a younger team, like undoubtedly it's on the younger side of things, but we've had some really good mentorship. Secret Labs is the protocol level team. They're one of the partners of Shade Protocol, so it's been an honor being able to work with them. And recently, we're partnering. I think we're up to 3 other external teams besides the core team that are partnering with us. So we have a Slack with like 20 developers in total, like it's all building Shade Protocol, and the level of knowledge share is just really, really speeding everything up on everyone's development. So long story short, it started small. You mentioned Guy, phenomenal contributor and incredibly bright developer, and it's been a fun journey pulling the team together. That was a long rant, but that's a little bit of the story about the team.
No, that's a great breakdown. You mentioned Secret Network. Let's just dive slightly deeper into that. So, can you tell me why did you guys decide to build on Secret Network specifically, and also comment on its throughput and finality? I know there are some other privacy-based networks out there. I think Oasis is one of them. Why specifically Secret? And also comment on the throughput and finality.
Totally. So Secret Network, quite simply put, was the first to market. Like if you rewind the clock back to 2020, there wasn't any other privacy preserving smart contract chains. And the analogy I always like to use is that I'm a firm believer that Secret Network is going to be the Ethereum of privacy DeFi and privacy solutions. As in, I do think other solutions will come along. They'll have their edges, but at the end of the day, like the majority of capital and original organic builders are going to coalesce around this tech stack for 2 reasons. First off is front-end frameworks. People don't necessarily do this, but as builders, when there's frameworks available for you, it's way easier to build what you want to build. So Secret Network, that first, from 2019 to 2020 to 2021, there wasn't much development, and people were like, where's the development? It's like, well, the frameworks didn't exist yet. So now there's front-end frameworks where the developer can come in and quickly connect, build their front-end interface to attach with a wallet, talk with the Secret Network blockchain super easily. So development is way faster now. Second is contract development framework too. Like on a low level, we now are having frameworks emerging. So long story short, the decision originally was we can't build what we want to build anywhere else. And the second reason was we get to work directly with the people that are building out the frameworks on our network. And so as the frameworks scale, we scale with them, and we have just a very tight alliance and communication on within our entire builder community. I know you mentioned Oasis, and we've looked into those communities. We've looked into them as alternatives, but I have not seen the frameworks emerge on their networks. They're doing very unique parts, like how they're breaking down throughput versus consensus. Like there is definitely differentiation from Secret Network. Currently, we use the Byzantine consensus algorithm, Tendermint's algorithm that all the Cosmos SDKs have. Works really well. Our throughput's around 22 to 23 transactions per, approximately per block. It's like 6-second block times right now. We've seen in cases of major strain on the network, we've seen those block times get a lot slower. So there's a lot of evolution that's needing to happen on the node runner side and on the performance optimization side. The good news for Secret Network is it is hardware-based solutions, which means as better hardware comes along, the network scales with it. So we use something called SGX, which is one of Intel's proprietary pieces of hardware. And the next generation of SGX comes out in 2024. And that, from everything we've seen, that would scale the throughput potentially up to 1,000 transactions per second, which sounds absurd, but it's literally that big of a jump from the current set of hardware. So to comment on finality and speed, it's we're at the early stages. And
so do you reckon it will follow? It will follow like a Moore's law, where it will with time, the throughput will basically increase or double every 4 years.
Yeah, essentially the amount that we can push through onto nodes will just be significantly higher. I don't think block times would be slower necessarily, but the amount that we could shove into a block and process without breaking everything, there'll be a lot more complex computations that can happen, and that's what we need. When you're having a lot of usage, you got to have as much throughput as possible, and the hardware side of things should help with it. And the protocol level team is also working on smaller optimizations, like parallel computations attached to some nodes. And there's even people have started to talk about, could we spin up some sort of sister chain or side chain specifically for certain throughput attached to certain DeFi protocols? So as a community, like, we might have to get creative with it in the interim, but I am confident that we have the right people in place to scale Secret Network to the throughput that's going to be required of it. So, yeah.
So one follow up question I have is that because of the shade airdrop, secret network at the moment has been congested.
Yep.
Now, when the main net launch, I think it would be second quarter of this year. It will be 4 times larger. The airdrop will be 4 times larger, and
Yep.
so how do you think secret network will go about handling this? What has been the discussion within the community and also with shade protocol?
Sure. So the most complicated part of the airdrop is the account registration process on the contract. So because it's a multi-chain computation, that computation is by far the most complex part of the airdrop. So once you get the addresses registered on the contract, the rest of the other 80% that's coming, those claim transactions computationally are significantly less complicated. So we're actually not as worried about the other 80%. What we're worried about is getting as many users essentially registering on the contract with the account registration process, how that works. So to answer your question, I guess our biggest fear would be a couple months from now, a whole set of like 40, 50, 60, 70, 100,000 people come that didn't come round one and are going to have to do the registration computation. It's not the claim transaction that's complicated. It's not silk transactions A to B that are confusing. It's the actual multi-chain account register, which is, by the way, incredibly unique the way we did it. I believe we're the first team to directly integrate with Terra Station as well as Terra. No one else has done an airdrop to Terra from an external chain. We're the first team to do that. It was incredibly complicated because...
So in hindsight, would you still do it?
Absolutely, because the number of people that have come from the Terra community and understand the project's philosophy and our vision for it, like, an airdrop is ultimately a chance to identify the community that is going to be in alignment with the product in the long run. That's the people that you should be holding it. Like, when you're in the process of decentralization, that is who you want to get tokens into the hands of. So yes, it probably added on an additional 4 weeks of development to be able to airdrop to them, just being frank. And that was outside of our initial scope and planning. But the community that it's brought with and the energy that they've brought is 100% worth it. Yeah.
One thing I can vouch for Carter, like, I've been active on the Telegram. The community managers and Carter have been very active in terms of calming the community, in terms of being very honest with what's happening with the community. So it's one of the ethos I also like about Shade Protocol and the whole community they have gathered around them. So I think we have given our audience the whole context, the whole history. Now let's just jump into the problem you guys are trying to solve. Feel free to share your screen, and we'd love to do a deep dive on this.
Sure. Yeah. I mean, I've always said that great innovation starts with very, very big problems. That's ultimately the source of progress in Web3. So let me go ahead and share here. So when our team kind of gathered around the world of DeFi, these are a couple of the problems we first encountered. First, totally transparent DeFi applications. There's massive the front running problem on Ethereum is $1 billion plus problem. Transparent stablecoins encounter this problem where if I went to like the grocery store or I went to a hot dog stand and I bought something with a totally transparent stablecoin, the merchant would know my entire essentially bank balance and every transaction you've ever made since the beginning of time. That's completely untenable from a security standpoint. And no one's really talking about it because blockchain and Web3 hasn't necessarily fully integrated back into the world of Web2 in our everyday lives. So one of the theories of the team is the more integrated blockchain becomes with our everyday lives, the more apparent and important the privacy problem becomes. So transparent DeFi, a legitimate barrier of entry to bringing Web3 to our everyday lives. Second was fractured application layer ecosystems. You look at all these different blockchains and every application has its own token. Token A, token B, token C, you go to this website, this website, this website, and it's essentially dispersing out value to these individual primitives. And then these primitives have to be like super, super focused on extracting value for their very specific application. So we said, what if we could launch an entire cohesive set of DeFi primitives without a unique application token per primitive? The user experience would be better. All the apps that you want to use would be all in one place. One mobile experience, one web experience, your lend product, your DEX product, your stable coin, your insurance, your staking derivatives, your staking, all in one place. No confusing token for each one, just all unified under one token. In this case, for Shade Protocol, that token is Shade. It's the governance, treasury, and utility token of Shade Protocol. Silk is the privacy-preserving stablecoin, which we'll talk a little bit more about later. So, transparent DeFi, fractured application layer ecosystems, the confusing user experience across multiple primitives, and then another one we're extremely passionate about is sovereign currency peg stablecoins. It seems a little odd that Web3 is starting to coalesce and gather around dollar pegged stablecoins. You would think we have this very unique opportunity to design better and more stable currencies than the existing system. And so we've seen people say, oh, like this dollar stablecoin is decentralized. But how can you be decentralized when the monetary policy backing that stablecoin is by definition centralized? And so Silk as a stablecoin, it's the flagship product of Shade Protocol. It's pegged to a basket of global currencies, commodities, and even a little bit of Bitcoin, right? And the dream is, can we create an ETF of currencies and commodities that essentially is reflective of global value? And if we do this properly, if this works, Silk is more stable than any currency that's ever been created, which is an extremely bold claim, but that is what we are setting out to doing. And not only is Silk not pegged to a sovereign currency, a single sovereign currency, it also has that auditable privacy component that Secret Network brings. I mean, that's why we're here. We need the ability for me to transact with you and for you not to be able to see my entire bank balance, not be able to see all my transactions, but then also for me to have the ability to go back to my auditor or my accountant, hand them something which is called a viewing key, and they can decrypt my transactions. They can audit me. They can make sure that I'm not doing anything nefarious. But then the rest of the world, at the end of the day, isn't able to see my transactions. So
just to add on your point, Carter, one thing I'm bullish on is the global basket of currencies and commodities you guys are thinking about. So just from a current events and current affairs standpoint, so let's say if you had a stable coin which was pegged to ruble, and now all of a sudden, unexpected, even though there were some signals out there, but let's say Russia, for whatever reason, decided to basically invade Ukraine. The ruble right now is under a lot of pressure, the international sanction. So let's say if you had a stable coin that was backed to ruble, you basically would have lost a lot of money, especially if you're trying to kind of store it as store of value, for example. So I really like this idea of global basket of currencies, commodity to kind of hedge away that risk and diversify away that risk.
100%. And I actually have had people in the Shade Protocol community. We have people in Ukraine right now, and what we've been told from them is bank withdrawals are down to like $340. People at ATM machines are getting robbed. There's massive currency problems. And so right now, and obviously Silk isn't on mainnet yet. Silk is not out into the world, right? This is the vision. This is where we're headed. But if Silk existed in this scenario, you would have a totally decentralized, permissionless stablecoin with privacy that is able to retain your purchasing power even in the middle of a crisis as bad as a war, right? And that's because right now, like Bitcoin works in Ukraine, but Bitcoin saw, a 15% drawdown in a couple hours, right? But Silk, because it's literally designed to be stable and be resistant to that price volatility, would save people from that volatility. So Bitcoin solves the scarcity problem extremely well. But I don't think we've really reached the end state for what stable coins are capable of on a global scale. And I believe that Silk can fill that void. So that's sovereign currency peg stable coins. The next one is governance scalability. I don't want to fall down this rabbit hole because I'll keep this high level on this one. We'll just say that in the real world, we've seen examples of countries that have failed to scale because of governance. And in the same way, I believe that DeFi protocols that are even worth billions and billions of dollars, if you don't have an ability to scale that treasury, to decentralize out tasks and still have accountability from end token holders, that the protocol at some point is going to hit a ceiling because of that lack of governance scalability. And so with Shade Protocol, we've done a lot of deep dive research that's still in progress, where we're trying to create a system of branches and representatives, as well as your baseline token holders. I personally believe that one day, if all goes well, a year or two from now, I will be solely devoted to just doing governance research. I think governance is the end game. You have to plan for it. It can't be an afterthought. It always has to be, you have to have the tools in place to be able to scale governance as the protocol grows. I feel really strongly about that. Other problems are the over-collateralized models that exist today, like MakerDAO, like Mirror Protocol. A lot of these models are not capitally efficient. And so Shade Protocol uses algorithmic stablecoin models, algorithmic synthetic asset models to be as capital efficient as possible for end users. And finally, the stablecoin legal landscape is fascinating. We have all of these dollar derivative stablecoins. And the question is, will countries be okay with billions and billions and billions of dollars existing in the form, like let's say the Federal Reserve is like a layer 1, and let's say something like UST is a layer 2. Are these countries going to be okay with hundreds of billions of dollars of derivative dollars existing? Like, what happens if these representations of dollars breaks? What happens to those underlying economies? And legitimate bad ramifications could exist. But because Silk isn't directly tied to any one sovereign nation, it's almost like an interoperability hub between other global currencies and stablecoins. So I think Silk is uniquely positioned to have less regulatory scrutiny in some capacity, more regulatory scrutiny in others. So the stablecoin legal landscape is something as a team we also wanted to set out to solve. So I'll pause here. These are very big and real problems. And these are the things we're trying to tackle with Shade Protocol.
Thank you, Carter. This was very useful, and this was a great breakdown. Now, let's just just to kind of summarize the key takeaways for me, things that you guys are doing uniquely. For me, is like a whole suite of DeFi product under one dashboard, which is kind of easy to use. The UI UX experience for the user is brilliant. Then you have a stable coin, which is unique and more innovative. It's like the next generation. Like you had last generation, you could say UST and Luna. You are doing more innovation on top of it by adding two things. One is the privacy layer, and the second one is the basket to kind of diversify away some of the sovereign risk. And final thing that I kind of took out was trying to tackle the over collateralization issues that, let's say, Mirror Protocol and MakerDAO have. So basically, innovating on some of the things that are not working perfectly at the moment. So just taking from this on, let's just discuss how. Let's just break down the full suite of product. I know you mentioned Silk. Let's just do a deep dive on Silk, and after that, we can do a deep dive on how synthetic assets will work.
Sure. I'm still sharing my screen here. So we'll start with this. This was stablecoins. From 2020 to the end of 2020, there was about 12 billion in stablecoins in circulation. Jump back here, 2021, we popped up to north of 75 billion. And then if you go to 2022, this number is even higher, past the 100 billion. So the stablecoin adoption curve has been super, super fast. But I want to talk briefly about where Silk fits into the picture compared to other stablecoins you probably all know and love and have heard about. So it starts with Tether. Tether is this centralized stablecoin that gives you the promise that there's some bank account out there that can essentially one-to-one back dollars to Tether. And there's regulatory risk attached to this. There's also the fact that Tether has frozen transactions on chain. It's very centralized. And Tether originally was created to solve a very key problem, which is liquidity, right? Liquidity drives everything in DeFi. You have to have it. And so Tether was this way to get this digital representation of dollars onto the blockchain and get liquidity around it, right? But the DeFi community said, hey, we can do better. And this is where MakerDAO came in 2017, 2018 with this over-collateralized model. And the way it works is you put up $150 worth of collateral, and you're able to mint out, let's say, $100 worth of DAI, which is this stable coin that's supposed to be one-to-one with the dollar. And whenever the collateral that was backing that minting, whenever the value of that collateral drops, the protocol liquidates those distressed assets, sells them off for the stablecoin in order to reduce the circulating supply of those minted stablecoins such that it can stay at its target peg. Pretty brilliant system. Couple of problems. First off, it is not very reflexive in a contractionary event. This system of pulling it back to peg isn't instant. There has to be buyers and sellers of these distressed assets. And so the system wasn't reflexive enough. Second, the expansion of the token supply is based off of lending and leverage. People have to be willing to put up an over collateralized amount of value to mint out $100 worth of the DAI. And that's very difficult to encourage your essentially token supply is based off of lending. And we can do better. And that's where Terra Luna came along as a third generation stablecoin. They said, wait a second, is there a way to forego the over collateralized model and have a system where the amount of the stablecoin, in this case UST, in circulation is directly tied to demand? And this is where they came up with the algorithmic stablecoin, which I'll be talking about right after this slide. UST has done brilliant to date. There's over 12 billion UST in circulation. But Silk came in and we made 3 changes we already mentioned earlier. So pegged to a basket of global currencies, has the programmable privacy. And the third one I'll mention here is we actually added in 2 additional stability mechanisms. So the way Terra keeps UST at peg is whenever UST is trading above or below $1, there is an arbitrage opportunity for anyone in the world to participate in, where they essentially expand or contract the supply of UST and push the price back to the target peg. And the people that participate in this is retail arbitrage players and institutional arbitrage players. And we looked at that and said, great, that's a good amount of backing. It's worked well, but can we add on even additional stability? And so a Shade protocol, it's retail arbitrage players, institutional arbitrage players, and then also Shade staking collateral also participates in arbitrage, as well as treasury collateral. So whenever there's a disparity in the market, there is a smart contract that also participates. And so now instead of UST being backed by a bunch of collateral participating in arbitrage from retail and institutional, with Shade Protocol, there's 4 entities at play, essentially an entire monetary policy plus existing arbitrage communities protecting Silk's peg. So really there was 3 innovations with Silk. And so this is
that is similar to the OHM style bonds. Is that similar to the OHM style bonds?
Not really. So the differentiation is really this. It's a completely algorithmic stablecoin, and what we've done is instead of having any over collateralization attached to the model, there is instead 2 tranches of extremely valuable collateral that are arbing the open market. Right? Like it's at the end of the day, peg maintains its target price based off of arbitrage entities. And so we haven't added on an over collateralized system. What we've done is we've added on 2 additional pools of value participating in the arbitrage. And these 2 pools, hypothetically, are larger than any institution, larger than any retail arbitrage player. And so collectively between everyone, that's a lot of stability backing Silk, but it's still algorithmic at the end of the day with how it targets its peg.
Perfect.
So
let's go with this diagram, the Silk peg, and yeah.
Yes. So let me hide this button there. Okay, perfect. So we're going to use a dollar example here just to simplify. The peg is not tied to $1. It's going to be tied to, more than likely, its opening price will probably be $1.05 with how all the basket adds up and how the weights are attached to it. But for the sake of simplicity on this diagram, we'll assume Silk is pegged to $1. So the way this works is you have 2 tokens. You have Silk, the stablecoin, and you have Shade, which is the treasury and governance token. And whenever silk is trading at $1.02, which is above the peg, that's not good. We want to be able to drive it back down to $1. And so what anyone in the world can do is they can burn $1 worth of shade for one silk that the market is valuing at $1.02, right? And so in this process, you decrease the supply of shade, you expand the supply of silk, and what that person will inevitably do is they will sell the silk to realize that 2-cent spread, and they'll realize the profits of that arbitrage, and that is what pushes the price of silk back down to the dollar peg. Now, the inverse scenario is also true. If silk is trading at 98 cents, we need a way to push it back to peg. And so what people are allowed to do is they can burn one silk worth 98 cents for $1 worth of shade. And so this decreases the supply of silk, expands the supply of shade. And it's through this expansion and contraction cycle that silk was able to maintain its peg. Now, very sharp individuals will say, wait a second, you've expanded the supply of shade, right? And that is market capitalization essentially has to get pushed into silk to bring it back to peg. And this is why having fundamental revenue streams and utility tied to shade is extremely important in order for silk to maintain its peg, because shade has to have fundamental value. If there's no floor of value, then this whole algorithmic process is just, it's smoke and mirrors, right? Like there has to be legitimate value within the system, right? So Luna solves this by Luna's fundamental backing is transaction fees as well as swap fees between UST and Luna. And in a similar way, we can talk about in a bit all of the different legitimate economic value streams that go to shade that give it its legitimate value, such that when silk is in a contractionary event and we have to pull on market capitalization to push it back, that it's fundamentally real value that's getting pushed into bringing silk back to peg. And so in that 98 cent scenario, we burn the 98 cent silk, we mint out shade, we've reduced the supply of silk, and we've also reduced purchasing pressure on it, right? Or well, we reduced the sell pressure because we're pulling it out of circulation. So that is how the algorithmic peg works. That's 3 and 4 on here. That is identical mechanics to Terra Luna. So it's been proven that this model works, which is extremely helpful for us. We don't have to be the trailblazers on that front. But we also added on an additional mechanism known as entry minting. And the way entry minting works is users have the opportunity to send $1 worth of value to the shade DAO known as Synthesis, right? User sends $1 worth of Atom, Luna, Secret, you send to the DAO, and then we allow them to mint out $1 worth of silk or $1 worth of shade. And this is excellent value capture for the shade treasury because the treasury turns around, stakes these assets, and the revenue stream from this DAO, from securing these other underlying layer ones, goes back to shade stakers, right? So that's a legitimate economic value stream.
And is there any transaction fees you guys will charge that also goes back to the DAO?
Correct. So silk transaction fees also go back to the DAO as well as shade stakers, and as well as swap fees between silk and shade. Just like Terra charges a conversion minting fee, that's actually where the majority of their staking rewards come from, is conversion from UST to Luna, from Luna to UST, and all the arbitrage profits that's generated, right? And so the reason we're allowed to do entry minting, the only reason we're allowed to do that is because the treasury also participates in arbitrage, right? So you have to think, like, if we mint out that silk and that person immediately sold that silk, what collateral exists to be able to push it back to peg? And it's the collateral that the user just deposited to the treasury, because the treasury is also an arbitrage player, right? And so the more collateral that sits on the treasury that's yield bearing, the more stability silk has. And actually, we've seen Luna recently do this. They bought $1 billion worth of Bitcoin because they realized this exact problem. These community pools that are out there where people go and they request funds from it so they can go build apps. It's great, but you need those treasuries to have a more involved role in maintaining the peg. And so our goal is for our treasury to be worth, 10, 20, 30, $40 billion like a decade from now. We need so much value sitting on the treasury that, like, even a temporary dip from a massive institutional player, the treasury is just, it's the biggest player in the game at the end of the day, and it's decentralized.
So how are you thinking about diversifying that treasury? Because the way I see it, the diversification of treasury will also be crucial. Mm-hmm. So you did mention Atom and Secret. So what are the other assets we can kind of think about, maybe now in the immediate future, or maybe like in the long term?
It's an excellent question, and I think we're going to have researchers that are going to be spending an insane amount of time figuring out what is the best way to create a set of assets that are, volatility resistant. And I think we're going to be very focused on what I call hard assets in the long run, which would be like Bitcoin, Ethereum, XMR, assets that they're not necessarily native to the interchain Cosmos ecosystem and that have the majority of liquidity in the world of crypto. But we've also been talking about how we want to potentially have other stable coins a part of the treasury. This gets a little tricky philosophically, right? Because we're saying it would be helpful for the stability of Silk and Shade to have other forms of stable value that are uncorrelated to Silk and Shade be able to participate in buyback and arbitrage, right? Conceptually a strong idea, philosophically a little interesting, right? Because we're building a stable coin that's not pegged to any sovereign currency, but it would be nice to have other uncorrelated stable coins attached to the treasury, right? So we're still working through the kinks of, as this DAO and treasury grows, inevitably, what will the composition look like? My answer is focus on hard assets, and we have a lot of research ahead of us as we continue to scale. So
I love the answer. Now let's look into the synthetic assets and see how that accrues value back to Shade.
Yes. So synthetic assets, let me scroll down here. So we realized something that was happening with synthetics, which I think is super interesting. So the same evolution that happened earlier with stablecoins, where we went from an over collateralized model to an algorithmic model, is what we are now attempting to do for synthetic assets. And so for any of you that don't know what a synthetic asset is, what a synthetic asset is it's a token on the blockchain that has its price mirroring a real world asset, right? So you could have a synthetic wheat token, a synthetic gold token, synthetic silver. And as those real world assets fluctuate within those real markets, you have to have some sort of a system that shifts the price of this synthetic representation of that asset with that volatility and changes, right? And so what we realized is this model right here, it's pretty much identical to the Silk Shade model, but instead of targeting a stable price, we're instead tracking a volatile asset. And so instead of having Silk and Shade at play here, what we have synthetic tokens and we have stabilizer tokens. So in this case, we'll use Tesla as an example, although we probably won't do stocks out of the gates just because of the legal risks. There's probably more likely to be synthetic commodities and synthetic index tokens. But what you have is the same logical scenario where you have synthetic Tesla on the blockchain. Let's say it's trading at $20. And let's say in the real world, it's $22. That's not good. We need to be able to bring the synthetic asset up to $22. And so just like there's a scenario where you burn Silk for Shade or you burn Shade for Silk, the synthetic model, you burn the stabilizer token, stabilizer Tesla, for the synthetic token, or you burn the synthetic token for the stabilizer token. And so it's this same exact proven algorithmic model for stablecoins that we also attempt to use for synthetics. Now, I'll say this is highly experimental. No one has done this before. What is encouraging to me is Sunny Arwal. Recently, we had a little back and forth on Twitter. He brought up this exact model in December and said, hey guys, I have this brilliant idea, this ION token attached to Osmosis. What if we do this algorithmic model where we have ION and synthetic assets? And I was like, whoa. I've had that in white paper form for a very long time. Like this is not a new idea. Shade Protocol has been we already have a whip up on our GitHub on this. So that was interesting. But we had a little showdown because Sunny wanted it to be ION backing all the different synthetic assets. So all the conversion minting would go from ION to the synthetic asset and back and forth. But what we realized is initially it's very important that you have unique stabilizer tokens for unique synthetic assets, because if you have a bunch of synthetic assets all going back to a single asset, there's a risk that if one of those tokens completely lose their peg, that in order to push it back to peg, it's going to have to drain the market capitalization, in this case of ION, of that single token that all the synthetics are pegged to. So for us, we decided separate out the risk. So every synthetic asset has its own stabilizer token. And that way, if any single token fails, it won't kill the entire system. It would just kill that specific pair. So the value accrual mechanism for synthetics is just like there's entry minting into Silk with some stuff like Secret and Luna and Atom. There's entry minting into these synthetic assets and these stabilizer token with Silk. And as these synthetic assets are traded around, there's transaction fees that are accrued back to the Shade DAO, back to Shade stakers. And Shade stakers are also the ones that receive the stabilizer token airdrops to establish the initial system. So highly experimental. If this works, though, the system is not based off of over-collateralized positions, such that the premium that synthetic assets are currently having to, like synthetic assets on Mirror Protocol, UMA, there's premiums of up to 15% being paid for those assets. And so we had to ask ourselves, where is that?
That's because of over-collateralization,
It's
right?
because of the over-collateralization. Why would I mint out $150? Why would I lock up $150 worth of value, mint out $100 worth of a synthetic, and liquidity provide it, if I could instead just buy the synthetic and liquidity provide it? So it's this fundamental disparity in risk profiles that's creating a risk premium in pricing. And so if you remove the over-collateralized model, token expansion is then based off of the demand for the synthetic asset itself. And so when you remove that risk component of the system, hypothetically, the risk premium should be driven back to zero, right? Or at least should be far better pricing than what currently exists. So anyways, risk premiums, pricing premiums, I could talk about this stuff for a really long time. So
yeah, this makes sense. So one key risk I see is Oracle. So how are you going to like Oracle will play a key role?
Yes.
So how are you guys thinking about it? Are you guys going to use band? Like what will be the procedure there?
Yes. So we actually have a special partnership that was announced recently with Supra Oracles. Super sharp team. Band protocol is what we currently use on our testnet and what most of Secret Network projects use because it's the only Oracle solution available on Secret Network. But the end game is we need to have an aggregate between multiple Oracle solutions and multiple different dexes that are based off of amount of volume and amounts. But specifically when we're grabbing these external price feeds, the answer is have as many Oracle solutions as possible. Don't rely just on one. You have to have volatility and anomaly detection attached to these systems. So Oracle contract wise, that's been Jack Swenson and Guy Garcia with Band Protocol currently. I think the majority of our audits are going to be very, very focused on the Oracles because as we've seen in DeFi, the majority of vulnerabilities seems to come from Oracle manipulation. And Terra actually is really interesting. Back in 2019, they used to not have a conversion minting fee between Silk or between UST and Luna. And what happened is someone who had access to the real world price feeds of the FX markets, right? Like with the dollar, with the yen, what they were doing is they were front running the data feeds that the Oracles were grabbing from the blockchain. Like blockchain was grabbing real FX feeds and updating prices. And so someone was front running that within the conversion minting system. And so that's where this fee came from with Terra Luna, and Silicon Shade also has to have it because if there is no fee, then someone can just slowly drain the system over time because they have direct access to the data feed that the Oracles are also pointing at. So it's a front running thing, right? So fees within blockchain are interesting because they're actually, a lot of times it's a security component. Not having that fee there lets people manipulate the system in a way that shouldn't be profitable. So.
Yeah, that makes sense. I'll just give like one more follow-up question will be, you mentioned commodities and indices. So when we say indices, is that like, let's say ARK, S&P 500, is that the type of indices we are talking about? Or is it more like crypto-based indices?
The index that I'm really excited about in particular is a crypto index token. So what you would do is very simple, just like we are looking at for Silk, we're grabbing all these real world currencies, assigning weights to them, and they all summate up to a target price that everyone's arbing off of. In the same way, we would look at the top 100 cryptocurrencies, we would look at their market cap, and then we would go, market cap times the weight assigned to it. You do this for all 100, you have an aggregate sum of a price, and then people are able to arb it back to price as all these cryptocurrencies, as their prices change, then the crypto index token price would also change. And I think there'd be a lot of institutional retail demand if you could buy a token that is representative of like cryptocurrency as a collective market cap. Like what an awesome product and it's privacy
I
preserving.
agree.
So it's just like it's really, really cool. That's the one I'm
Yeah,
excited about.
one thing, yeah, one product I feel like it's missing in the market at the moment is like a layer one index. So for me, like let's say for me, I focus more on private deal side, but anything that kind of interests me on the public listed side is layer ones and layer twos and maybe layer zero. So if there's an index that kind of captures all of that in a and diversifies away the risk, I can basically whatever salary I get, I can passively invest. So I think that would be one index. If you guys have it, I'll like personally, I'll be a big fan of and use it. I can kind of
Yep.
see myself using it, and I also feel like you guys have a very interesting optionality. So let's say coming from an emerging market, like in 2020 when the COVID happened, I was like I was a equity analyst, and I thought S&P 500 and Nasdaq, some of the stocks, and even the whole index in general became very undervalued. But since I was in Pakistan, I just couldn't invest in that in those assets, right?
Yep.
And the interactive broker told me that it will take you 3 weeks, and that 3 weeks turned into like 4 months, and the whole opportunity to invest basically
Disappeared.
went away. Yeah, so the TAM I feel like of this kind of innovation in going forward, like if you guys also able to capture some of the asset, is in my view, I've done some research on it. It's approximately 100 trillion. The whole market side of these synthetic
Yep.
securities and assets could be that big. And the other interesting thing is it's not limited to one geography, right? Because of crypto, it's global.
Yep.
So for me, this is something as an investor, I'll be very interested in and closely watching you guys to see how you guys
And that's the
execute.
thing, like that's why like proving the mod, like we're starting small because we need to prove that this works. Is no one took the creative leap of saying, wait, this algorithmic model, like what if this works for more than just stable coins, right? And so it's like first we got to prove it in a volatilely liquid market. Is this able to work? And actually, the more liquid the market gets, the more safe the model gets, right? And if this synthetic model scales like we think it will, this will also be the largest arbitrage market in the world, potentially, because the whole system of maintaining the peg is purely arbitrage based. So as the synthetic market scales, there should be institutional interest that also scales with it because it's incredibly lucrative to be the ones that are helping maintain the peg and arbing it. So I don't want to let my hopes get too far ahead. And so step one is just prove the model, prove that it works in any liquid and volatile market. Step two is, all right, like this works. What are the exact products that institutions and end users want? Let's make those. And it's just one step at a time. But we can dream, but got to stay rooted in reality too. So
Yeah, so I had a discussion with you, and I believe there is a liquid derivative product also on the works. Like I believe similar to something like Lido, for
yep.
example. Is that what you guys are working on? More than happy to explore. I think this is something which not other YouTube channels have been able to explore with you. So it's my pleasure to kind of also explore this with you.
Yeah, so it's under audit right now, believe it or not. So we're pretty excited, but we believe we'll be first to market for the first secret network staking derivative token. And so for those of you that don't know what a staking derivative token is, essentially right now, when you stake, you lock up your collateral, you're passively earning rewards. And when you want access to that underlying collateral again, there's this unbonding period where you have to wait, 21 days to get back your collateral in a liquid form that you can then go to a market and buy and sell and liquidity provide, right? So this product a while back popped up that a lot of people are doing in DeFi, and they're called staking derivatives. And what it is you deposit your collateral into a contract that gives you out a liquid token, and then in that contract, your collateral then goes and gets staked and passively starts earning revenue for you. So all that we've done here, a little bit of hand waving, is I now have a token that is a claim on collateral that is passively earning revenue. So the beauty of this liquid token is we've kind of unlocked a representation of that locked value that we can then go to an exchange, buy and sell with other people that also believe in that derivative representation of all that locked value. And on Secret Network, for instance, there's over $500 million worth of locked collateral that's just sitting there. There's no synthetic representation of it. It's just there. And if we could unlock, think about the amount of TVL and value that and traffic you could bring to a DEX if you get your community on board with using a staking derivative. So what we'll be launching in the next 2 or 3 weeks is a Secret Network staking derivative token. The beauty of this all goes back to Shape Protocol. A small percentage of revenue from secret staking goes back to the Shade Treasury and Shade stakers. So if we get, 10, 15, 20, $30 million or 30, 40 million worth of secret in the staking derivative contract, Shade stakers, Shade Treasury is just accruing value from helping secure the underlying layer one and being part of the staking derivative market. And then on top of that, not only do we have the secret staking derivative contract done and being audited, we also are on the verge of completing the Shade staking derivative contract too. So you'll be able to lock up your Shade, passively earn revenue from all of that, and then also have a liquid token representing it that you can then turn around and use on a DEX on exchanges. So
and that will also accrue revenue and go
exactly
back to the treasury.
Yeah, and same thing too, like a percentage of revenue from that gets kicked back to the system. So it's all about real, tangible economic revenue streams backing the entire system. For all of you finance people, present value, essentially the value of a stock is the present value of future cash flows, right? And so the stuff that keeps me up at night is how can we create genuine cash flows that investors can look at and be like, wow, we can calculate an actual present value for this token. It's not just governance. It's not just utility. It's like, no. Like these are cash flows. Like this is legitimate value being accrued here. So.
Right. So you have cash flows, you have burning mechanism, you also have governance. So you have a multi use case for Shade protocol.
Yep.
And we already saw what happened. Like, I don't have to remind our audience. We saw how Luna is doing today. The whole market is kind of tanking. Luna is holding value because it has real utility and there are different demand sinks and then value accruals, and Shade is trying to innovate on that and try to, like, they're also thinking about adding more utility.
Yep.
Just on that point, what are some of the other future optionality and DeFi suite like different DeFi products we can also expect, and how that can also accrue value to Shade?
Yep. So the big ones that we're really eyeing down would be a lending product, a DEX, and insurance. I think insurance is criminally underexplored in the world of the blockchain. It's going to be, I think insurance is going to be like a 2024, 2025 narrative that's going to sweep in and be like, how did we miss that? Like it's 100% a key DeFi primitive. But on the lending side, the Anchor has proven on Terra Luna that tapping into proof of stake blockchains, helping secure the networks, tapping into that APR stream for stablecoins, insanely valuable. And so in the same sense, we will build an Anchor-like product. It's 100% on the roadmap. I'll just say there may or may not be people that are already building it. So like we're very excited. On
this may and may not be an alpha leak.
Yeah, it may or may not be an alpha leak, but there's some good stuff happening on that front. And the difference here is like Anchor token, how the incentives had to be designed for Anchor protocols, like, oh, we have to accrue value for Anchor token. But for us, there's no new application token. That's one of our principles. So 100% of the revenue stream and value capture goes right back to Shade stakers, right back to the treasury. No divergence in incentives, no divergence in governance reasoning, right? Because we're all the primitives are all serving the same system. And you'll see on these applications, you can look into their governance, and there are people who are like, oh, we need more value capture for our Anchor token. And there's other people that are like, no, like this is like a public good for Luna, right? And it's these divergences that we're never going to have to deal with because there's no diverging incentives. It's everyone's under the same umbrella of Shade token, Shade primitives, suite of applications, all connected. So yeah, and on the DEX side of things too, I think it's definitely a necessary final piece of the puzzle. And we are going to build as fast as possible. I believe we're in a unique time in human history where privacy preserving DeFi will be obvious in hindsight. Mark my words. Like it's 100% going to be needed to scale to institutions. And there's a couple of strategies we've seen people try to do. A lot of people, they've tried to like go create permission chains, round up institutions, then everyone's using a permission blockchain and there's privacy, but it's like, that's not where the value is. The value is not, it's like going back to the internet where you had intranets and you had the internet. The value is on the internet. It's not on the intranet, that closed system. And so our strategy is build the key DeFi primitives with auditable privacy and then pull in the institutions, as opposed to try to build a layer one, get the institutions convinced that the primitives are then going to be built. It's like build the primitives first. Here's the KYC AML platform that plugs into all these privacy preserving DeFi, and you can jump right on in. So the roadmap it's crystal clear what we want to do. It's just a matter of execution at this point. And that I can't always say that was the case. This is many months and years of like dreaming about this privacy preserving DeFi vision. And a while back, I couldn't say that it was just down to execution, but I truly believe we are reaching the stage where this is just about executing. We have the vision. So
So Carter, just to ground you for us for a minute, you spoke about execution. So, what are some of the execution risks you kind of see with Shade Protocol going forward? And can you also help me kind of walk through? I believe this the unique selling point of Shade Protocol for me is the unique token
Yep.
economics. But the one risk I see with the DeFi at the moment is that you have individual tokens that are basically inflationary in nature that bootstrap the network. So Shade Protocol is deflationary in nature, has a limited
Yep.
supply, doesn't have extraordinary inflation. How do you how would you go about achieving those network effect from scratch?
Excellent question. So 12% of supply is pulled aside for grants, right? And we are already activating it to build out the key primitives that have tangible economic returns. And so when this is the beauty of being an application layer ecosystem. We know the 7 or 8 primitives that we want to build. Whereas at the layer 1, they have to design a system where an infinite number of applications can be built, right? And they need to be able to secure those infinite number of applications into perpetuity, right? But we're not a layer 1. We're built on top of it. We inherit the security model of secret network. And so we don't need an inflationary model to secure our system because we just inherit it. We're built on top of it. It's one of like the subtle but very key differences. And I know Cosmos is always this kind of narrative that's like every blockchain for its own application, but I think there's trade-offs to that. Like if people act like there's not trade-offs to that, there is trade-offs to that, I promise you. And so we're making that key decision to inherit the security, and that simplifies. Now, grants program, you have to deploy capital aggressively. You have to have the humility to let go, decentralize the protocol, get other really big builders in on the vision. I think that's where a lot of projects go wrong. They don't have the humility to let go. And that's like, you have to have that ethos in order for things to decentralize out properly. And it's also what it takes to grow the pie. Would you rather own 20% of 100 million or 5% of 100 billion, right? Like, and I think that's the game theory a lot of original founders and builders lose track of, right? So I think we, as a team and as a community, we're not losing track of, like, in order for this vision to work, there needs to be many, many builders involved, and you have to spread the love, right? And back to the inflationary point. If you can build the primitives, which we know what our 7 or 8 primitives are, we have them mapped out. If you can just build those as fast as possible, and those are real, genuine fees that are being built, they're not. It's not inflation. It's a user saying, perform this service for me. I give you this fee that is tangible economic value. If we can spin that up, we don't need inflation. It's just actual value accrual to the treasury and to stakers. And inflation's it's an interesting tool in blockchain. I could talk about proof of stake for a very long time. But we'll just say, I guess I'll just simplify it and say, we want to avoid inflation whenever possible. You have to bootstrap, right? So we have our 10 years of rewards pulled aside for staking and for liquidity providing. But we've made it very clear that, like, protocol and liquidity and bonds and true economic revenue streams, that is where the value is. And people should not interpret those staking rewards or those liquidity providing rewards for the first 10 years as genuine economic value. Like, that's not. It's just value dispersal. It's necessary. You got to bootstrap a protocol, but it's not the long-term solution. And I promise you, there are so many dexes out there. There's so many tokenomic models where it's like, well, what's the value of your token? Like, why would I perform this action? Oh, well, it gives you a token. And it's like, well, what does that token do? Well, it gives you more of the same token. And it's like, that's not real economic value. And those systems, they're going to collapse on themselves as the APR streams drop, as the emissions drop. They're not actually capturing enough economic value to justify the valuation for that token. And DeFi will be survival of the fittest, and the fittest are going to be the projects that have real economic value. End of story. So
That's great. Yeah, makes sense. Like, I'll repeat this, and I'll want you to help me kind of revisit the token utility of Shade. and how it accrues value again. Because I think for me, like from an investment perspective, that's the beauty of the whole protocol and the DeFi suite you guys are building. So I think just for our audience to just have another takeaway, I think it'd be great if you kind of walk us through again all the token utility, maybe through one of the overview pages you have on.
Yeah,
on
let me share my screen here real quick. All right.
And for our listeners, this article and some of the other articles recently published by Shade Protocol will be in the description down below, so you guys can read about it and do a deep dive. And at Token Metrics, we're also doing a deep dive, and the report will be available for you guys shortly.
So step one, Silk transaction fees. The more Silk gets adopted, the more treasury and stakers accrue real economic value, right? Second revenue stream is conversion minting fees. So when people arbitrage between Silk to Shade, Shade to Silk, just like Terra Luna has a conversion minting fee, we also have a conversion minting fee. This is necessary from a security standpoint. It is also one of the strongest value accrual mechanisms that you could possibly have with an algorithmic stablecoin. Fees, the transaction fees and the conversion minting fees, in terms of staking APR, currently with Terra, that makes up like 80-90% of the revenue attached to that, right? So we have one, we have two, those are proven models. We have the 10 years of Shade staking rewards. As I said earlier, it's not a substitute for genuine economic activity, but it is an incentive. It is value dispersal. So at least for the first 10 years, it's something to draw someone in. The Shade Treasury. So Shade Protocol is launching bonds with it such that we are able to pull in uncorrelated assets onto the treasury. We also have the entry minting mechanism. And what this allows the treasury to do is it's gathering all these layer one tokens, and we're able to stake these layer one assets, which are earning revenue stream from staking rewards. And we're going to be redirecting those staking rewards back to Shade stakers and to the treasury. So that's another genuine economic revenue stream that no other protocol, like that's not normal. These are new leaps that are being taken. The treasury will also be participating in liquidity providing. So as we pull in LP tokens with the bond mechanism and with entry minting, the treasury is passively earning LP rewards on dexes. Where do those rewards go? Those go straight back to buybacks of Shade, burning Shade rewards, right? We have the staking derivative revenue stream we mentioned earlier, right? We're tapping into the proof of stake security system. Same with the liquid staking derivatives for Shade staking. We have synthetic assets. Every time someone's conversion minting between, synthetic Tesla and stabilizer Tesla, just like these two streams right here, that would exist for every single synthetic and stabilizer pair that we launch, right? All of those are going straight back to stakers. The lending product, which I'm alluding to earlier, all of the interest fees from that lending product, guess who those goes back to? That goes right back to Shade stakers, right back to the treasury. Any future decentralized exchange that gets launched, all of those swap fees on those dexes, guess where those fee streams would go back to? Shade stakers, Shade treasury. So the rules of the game are super simple. Launch the key primitives, bring the revenue streams back, unified under one token. How far will that take us? We don't know because no one's really done it like this. So
I read something about the airdrop. Can you elaborate on that?
Yes, that's actually a really good point. So the stabilizer tokens that are being launched for every synthetic asset are going to be going to Shade stakers. So that's like synthetic wheat.
May not be
all those airdrops are going to stakers, which I think airdrops as like a legitimate form of revenue. Like it's been proven by like Atom that it's a thing. I just don't. It doesn't feel like as sustainable to me, right? Like it's bursts of value for users. So it's definitely something to be mentioned. The other one that I don't have on here, this article needs to be updated. And I actually wrote this article. So I'm actually a little disappointed I don't have it on here. But Shade stakers, your collateral gets deposited into the arbitrage contract that helps maintain Silk's peg. And so those arbitrage profits generated from the Shade staking collateral, those also go back to stakers. So this really should be included on here. After this interview, I'll definitely update that because that's a missing revenue stream. So anyways, hopefully that gave a little bit more of a concept that it's like, we're not talking about one or two value accrual mechanisms. We're talking about every key DeFi primitive and just pointing it straight back. So
thank you, Carter. Thank you for this detailed breakdown yet again. So Carter, before we conclude, is there anything we might have missed? Is there anything you want to put across to our community and to our YouTube audience?
Well, I would say first off, like, thank you. Like, there's a lot of complexity here, so I'd encourage you just like join the Shade Protocol community, shadeprotocol.io. Follow us on Twitter. We even have a group called House of Shade. There's 4 community members that are spinning up a podcast just for Shade Protocol. Like, man, that starts to be. My brother texted me the other day. He's like, "You got to check this out." Like, I'm like, wow, like we don't know these people, and they're spinning up podcasts just for Shade Protocol because you know why? Because this is a genuinely ethos driven project. So there's so many projects out there that price go up is the ethos. But with Shade Protocol, what I'm noticing in our community is there's 2 things that really unite us. The first is this firm belief that privacy is a human right and that privacy is utility. The second one is that the world of stablecoins can create something that is separate from any country, more stable than any currency has ever been created, that can genuinely make the world a better place amidst crisis. So with the recent happenings in Ukraine, we have people from Ukraine in our Discord. Go check it out. Like, people believe in this mission. The world believes in Silk and what it can do. So I would just invite you to come along for the ride. The other thing I would throw out there is obviously the scope of what we just described. It's incredibly vast. And so I want to make it crystal clear that this is not just one team. We are nearing, at this point, it'll be close to 4 to 5 teams that are building under Shade Protocol. And like, not all of that alpha has been leaked. We leaked a little bit of alpha today on the staking derivatives, maybe a little bit on the lend, right? But like, this is more than just what was described. There is many a team that understand this vision. And it's just going to be exciting to see it grow. So yeah, thank you so much for bringing me on and listening to me rant about all the economics, and it's a really good time. So
No problem, Carter. I will also love to have you next quarter when everything is sorted out, when you guys have a mainnet, and then we can try to kind of help you leak the alpha for our audience.
Yeah.
And yeah, for me, the key takeaway from this conversation has been the amazing tokenomics of Shade, and also how enthusiastic you are about the project. It's quite contagious. And full disclosure for our audience, I'm also invested in Shade Protocol. So thank you for listening, and thank you, Carter, for joining us for this episode.
Appreciate it. You have a wonderful day, and everyone out there, have a good one.